Lee Schulz, Iowa State University Extension livestock economist, is our market analyst this week. Last week, the U.S. Department of Agriculture released the Cattle on Feed report. In the report, USDA estimates there are 11.7 million head of cattle and calves on feed. The inventory was up 9% compared to 2017. Placements in feedlots were up 7% at 1.82 million head. According to Lee, the increase could be a result of the dry conditions in the southern plains, forcing stockers off winter pastures. Meanwhile, the lean hog futures market continues to see a sharp decline in the month of March. The quarterly USDA Hogs and Pigs report is set to be released on Friday. We spoke with Lee Wednesday afternoon and began by asking him about the Cattle on Feed report.
Well, I think it confirmed what we thought. Some inventory levels are higher. You know, we did see much larger number, especially when we look at the placements number. That was pretty wide open going into the report. Pre-report expectations had placements anywhere from same as a year ago levels all the way up to about 8.8% higher. We did see it 7.3% higher. That was higher than the 4.5% coming into the report. I think what that really does confirm, though, is what we've seen, especially in the southern plains, with deterioration of those conditions, really have pushed more cattle into feedlots a little bit earlier. Maybe the cattle that we would have thought coming off of spring wheat would have came in April, May. I think those were put on feedlots maybe a little bit earlier, so that jumped up the placement numbers. But really, when you dig into the placement numbers, I think it's coming from the larger feedlots. In Iowa here, we're the only state that surveys less than 1,000 head feedlots, and those numbers really show placements were down almost 25% compared to last year. So I think it is because of some of the profitability conditions. It is the smaller farmer feeders maybe taking a step back, and the larger feedlots really putting more cattle on feed because of the larger supplies that are out there.
Let's dive in more on a few of those cattle on feed numbers.
When we look at the marketing number, that was probably the closest to pre-report expectations. It was 1.6 above year-ago levels, 1.4% was the pre-report expectation. So there's really no alarming factor when we look at that, but I think that's probably the biggest number to keep an eye on. As we've seen, this last week, slaughter was down 2.3%. The last 3 weeks together, it's been down 1.8%. So probably the biggest concern in this market is we're building these cattle inventories, and the marketing or slaughter pace is slowing down. And so that means these cattle are going to continue to build, and that's going to continue to pressure prices downward. I think the demand is going to pick up as we get into that summer grilling season, but also the supplies are maybe picking up a little bit faster than we thought. So that's a factor that could, impact these markets. Add on top of that, we've seen weight increases. Seen it in the last report that it was up 2.3%. We're 15 pounds above the 5-year average. So that's adding considerable weight to these animals. And so not only are slaughter numbers larger, but beef numbers are larger. So that's impacting the overall beef aggregate supply, and another factor that could somewhat pressure these prices.
You mentioned the prices. How do they respond specifically to the report, and what's your outlook as we continue into quarter number 2 of the year?
Well, if we look at this report, I think most would view it as a rather bearish report, but I think the market was anticipating this. As we've seen, the week of that report, prices were down, and so I think a lot of what was already bid into market prices was the bearishness of this report. But we've really seen a downturn in prices. You look back to February 20th, the last time we've seen a peak, we're down $15 per hundredweight over that time period. So we've seen quite a bit of money come off those futures prices. Now, the first 3 months of the year have been fairly profitable for cattle feeders, but as I think we turn into April, we're going to start to see those margins turn negative. One, because feeder cattle prices that at placement were rather high, but also now we're seeing the downturn in these fed cattle futures and cash prices. Also, looking at the difference between that June and April contract, right now it's about a $10 difference. Really the question is, where will that converge? Will the April contract go further downward, or will we see a jump up in that June contract? I think where numbers are really right now, it may be a little bit bearish in the market, and we could see prices suppressed a little bit here in the short term.
Let's shift into the hog side of things. There's a big report due at the end of the week. Remind us the report and its importance.
I think the numbers we really got to keep an eye on is the sow farrowing intention numbers. So if you look at for March and May, that number is expected up 2.1%. June, August, 1.7% up. Those may be a little conservative, at least what we've seen the trajectory the last several reports where intention numbers were smaller than the actual numbers that we've seen post-report. If those numbers in fact are larger, that means pig crops are larger, inventory levels are larger, and the need for growing demand is needed to help hold these hog prices higher. We've really seen hog prices pull back here. This is the first time in a while I've been estimating below break-even profitability for 2018, now just slightly below it at $2. But I think there's a lot of factors that could weigh on this market, which could push down especially fourth quarter prices.